Hey guys, V. Rigoni, Max, high performance real estate entrepreneur. So we're going to talk a little bit today about Jay Powell. What's been going on? Well, as we know, they raised those interest rates, 11 times over the course of about 18 months? Now they haven't done anything for a while. I just recently heard him talk, and what he said just blew my mind. But hey, before we start, don't forget, if you like the content, hit the like button, all right? Or follow along for more content. Don't forget to do that. But hey, so we're sitting there, and I'm watching this thing regarding Jay Powell. I read an article recently about him, and one of the things that really blew my mind was that he made the statement recently that interest rates, the rise of interest rates, has not had the same effect as it has in the past. That he's not seeing that effect. Well, duh. They just had gotten done printing almost $7 trillion of money. $7 freaking trillion, all pushed into the economy over the course of about 18 months prior to him raising interest rates. How could he in anyone's right mind could you think that was going to have the same impact after the fact of pumping all that money in as it did back in the 1980s? And that's really the only place where he can really go. There's a couple other times where they've raised rates a little bit to slow the economy. But the last time they had to do it in a major way was the inflation of the 70s into 1980. And then they raised interest rates significantly on a percentage basis. They raised them less than they did this time. But the impact then was it created almost immediately a recession that lasted for like almost 4 years. That's why, once again, when this started 2 years ago, a little over 2 years ago, I kept saying to people, this is not going to end quickly because of the fact that, number one, when the Fed creates the recession, they usually end up going overboard historically. But in this case, even though they've raised interest rates on a percentage much higher than they did in the 1980s, you have a situation where, because of all that stimulus that was put into the marketplace the 2 years prior, from COVID on, they just couldn't overcome all that financial stimulation into the economy, even though they then proceeded to raise interest rates 11 times over 18 months. And now it's been about 4, 5, 6 months since they raised rates, but they've left them. So now they've gone to this, higher for longer. They went to that. They actually thought they were going to be able to cut rates this year. Well, they're seeing that may not even be possible because he's not getting the impact in the economy that they were hoping for. As soon as they get a little bit of a slowdown on some of the numbers, then boom, other numbers come out and say the economy is still pushing forward. And they didn't raise all these interest rates just because they want to be jerks. It's because they know that they had inflation at over 9%. And remember, calculated as they calculated today, not calculated as they calculated in the 1980s. If they would have calculated it the same way, it'd have been somewhere around 14% inflation. And so, yes, they have knocked it down, but they're not getting it where they want it to be before they start to cut interest rates. Because what happens when you cut the interest rates? It's a re-stimulation of the economy. When you cut interest rates, you lower the cost of debt. When you lower the cost of debt, then more people borrow more money. That money goes out into the marketplace to create what? New companies, new businesses, new jobs, higher wages, which creates then more inflation. And so, yes, they know that they've got to, they've got the thin red line to kind of run along, and they know they have to do that. But in the same token, they've definitely been acting in a very conservative manner in the last several months, because even with the data coming not out as they would hope, they've been just kind of hanging on. And then pushing the fact that they may end up cutting rates towards the end of the year. But it gets really difficult in an election year to cut interest rates prior to an election. We've talked about that because historically they will not do that if it gets too close to the election. And why? Because they don't want to be seen as influencing the election. So you got to be really careful around the idea. Now, what is it causing? Well, it's causing home prices to stay where they're at. People, why? Because there's a lack of inventory. And so when there's a lack of inventory, home prices can stay strong. Now, I'd have thought that we would have had more, a softer on home prices. But because of the lack of housing that's out there, it's keeping these homes prices up in most areas. Yes, there are some areas where prices have dropped. I guess condos in New York have dropped. Some property values in Austin have dropped. But these things were so hyperinflated that, once that stimulus was gone, they had to come down to some level. But your single-family homes in the Midwest, they're not dropping. They're still getting multiple offers. Yes, there's some a little bit of softness in Florida, but that softness is just the fact that super overpriced houses have to reduce their prices to get real. But the homes are still moving. They're not moving with 5 offers every time they put it up on the market, but they're still moving within a reasonable period of time. And you got to understand, you just got done with this giant migration out of New York and New Jersey due to the pandemic, right? Due to the tax laws of those states. And so all these people came flooding in. Plus, you had a pretty decent migration from Illinois and from all the other northern states. Now, has that subsided? Yes, somewhat it has. Plus, the costs of other things have gone up in those areas, like insurance have gone through the roof because of the last big hurricane that hit in Fort Myers and Naples and all that area a couple of years ago. All these things have happened. And then the building that fell down in Miami a couple of years back, and now there's all these new regulations in Florida where any building above 3 stories residential has to be, inspected. And then anything they find has to be acted on within a certain period of time after the inspection. Well, what's happening there is causing all those HOAs, the homeowners association dues, their special assessments. They say it's going to be anywhere from $20,000, $30,000 all the way to a couple $100,000 based upon the the delayed maintenance, which then creates damage of these buildings because they do not want another building collapsing just because it wasn't taken care of. So that's, so there's certain areas that, yes, have gotten a little bit softer, but in the Midwest, in the Chicago market, metro market, not at all. It's staying strong. But what is coming down is the multifamily. You're getting some of the cap rate expansion. When the cap rate expands, then the prices come down because it works as a multiple. And so you're seeing some of that. You're also going to see more and more of people, like we've been talking about, getting in trouble. Well, they're already in trouble, but having to deal with the trouble they have from having used hard money 2 years ago to buy a multifamily building and then borrow more hard money to fix it up. And then all this hard money gets really expensive as they have to keep trying to renew it, and they're going down the drain. So there's that problem. The other problem they have is when they were borrowing money on an adjustable rate mortgage, very similar to what took place in 05, 06 during the residential single-family housing market that then ended up where what happened to those types of adjustable rate mortgages when they were getting those rates, and even though fixed rates were at historical lows, they were still trying to get adjustable rate mortgages in order to get the interest rate down to 1%. Well, those are the ones that got totally burned when the market crashed, and then interest rates jumped. Well, the same thing is happening in multifamily today. There were guys out there that went out and they bought multiple multifamily buildings, and they either bought them with hard money thinking they were going to fix them up and flip them fast. What I mean by fast is a year and a half. They could handle the higher interest rates, but now it's been 3 years, 4 years. They're getting screwed. They've got buildings that are fully renovated, they're fully rented, and they don't have enough money coming in to pay these hard money loans. All right. Or what happened again is that they went out and got adjustable rate mortgages because they could not buy the building with a fixed rate, even though at the time the fixed rate was the lowest rate it had been historically. They still had to get an adjustable in order to buy it. And now look at what's happening. They can't, again, they fixed it up. They got the building completely redone, and it's losing huge money. Well, those buildings will go from what they call weak hands to strong hands. And they've been hoping and praying, and I mean praying, that the Fed would have adjusted these rates down 3-4 times already so that it would give them some relief. Well, it doesn't look like that, based upon what the Fed is talking about today, that's happening anytime soon. So there's going to be huge opportunities in this multifamily space. Figure out how to take advantage of it. You can do it through real estate syndications. You can do it by creating a real estate fund. You might say, oh my God, how could I do that? then participate in somebody else's fund, participate in somebody else's real estate syndication. There's going to be opportunities out there that we haven't seen in real estate since 08, 09, 2010. But it's going to be in multifamily. It's not going to be in single family. Now, again, figure out how to participate in it. I mean, we created our own real estate syndications. We've created our own real estate funds. We figured out how to do that. You can do the same thing, or you can go participate in somebody else's. But you want to buy when there's blood in the streets. And let me tell you, folks, the blood in the streets for multifamily, it's happening. Now, again, it's not happening in all areas. It's not happening on all buildings that are multifamily. But it's happening in the segment of the multifamily that took on hard money, that took on adjustable rate mortgages. These are the ones that are going to be killed. So there will be opportunities out there, no different than the residential market. Not everybody got foreclosed on. Not everybody had a bad mortgage. Not everybody spent their equity and then refinanced it with an adjustable rate mortgage to lower the payments on the credit cards. No, but the dumbasses did, and the ignorant and the conned. Plenty of people got conned in that day back then about buying houses that couldn't afford them. Same thing happens in the multifamily space. You think just because somebody understands multifamily that they can't do stupid shit? They do it all the time. They get overextended. Listen, we talk about it all the time. Leverage is amazing. You use leverage to get wealthy, but too much leverage, too much debt at the wrong time can also cut your throat. It can also drop you down hard. So you want to use leverage as your ally, as your friend. But you can never put it in a position to put a gun to your head. And we all say that metaphorically, right? Never want to put a position where it's doing that. You'd never want to put it in a position where the debt can destroy you. Always position yourself where the debt is an advantage, not a disadvantage. So remember, it's coming. This opportunity is coming. Real estate takes a long time to go down. And when it gets down there, it stays down for a long time. We're getting there, folks. It's coming fast now. It's going to be happening. I've been talking about this for 2 years now, and it's coming. So, hey, figure it out. Figure out how to participate in it. If you want to know more information about how to do that, in fact, like how to become a syndicator, how to become, a real estate operator, throw me a comment. Throw me a question. I'm happy to answer them. Let's get out there. Let's make it happen. V. Rigoni, Max, high performance real estate entrepreneur. And remember, what do I always say? Think big, start now, grow fast. That's right. Think big, start now, and grow fast. Talk to you soon.